Welcome today to our session at the box. We are talking about inflation today and the implications in terms of underinsurance for brokers and their clients. So I'm Ben Hardiman. I am a partner in our insurance disputes service line. And for our talk on this topic today, I'm joined by Charlotte Clarke, who is one of our senior associates. I'm sure most of you will have been on a Mills and Reeve webinar by now, but just a quick bit of admin. There will be a recording available afterwards if you want to share that with your colleagues, and we will send you an email providing you with a link. If you have any burning questions, feel free to pop a question in the Q&A box. If you maintain anonymity, we won't be able to respond afterwards, but if not, we will, if we don't have time, respond to you, dropping you an email or something afterwards. And finally, we have a feedback. We always have a feedback survey at the end, and we really value the feedback you provide. So let's crack on and the box and our focus for today. So we're talking about underinsurance. Charlotte will kick off it just after I've introduced by talking about how underinsurance operates. Keep your ears open for that bit, because there will be a poll to test your thinking this earlier on a Tuesday morning. I'll then talk about the implications for brokers and their obligations, and then we'll give you some practical pointers to follow on from that. Just to kick off then, I wanted to start a webinar about underinsurance with a few stats. And I think really the starkness of the stats can be shown by the difference between the dark purple line, which deals with what policyholders think, and the number of sort of light blue grey coloured lines below that, which is what the professionals think. And you'll see, I'm not going to go through, but the numbers are so vastly different. It just shows why this is such a big topic. Just to compound matters, this is all historic data. So this information provided by the likes of Sedgwick, Charterfields, etc., doesn't take account of, because it was provided prior to this, what really is a perfect storm of factors, such as the war in Ukraine, the global energy crisis, and those drivers of the spike in inflation that we are currently experiencing, and what looks likely to last well into 2022 and beyond, 2023 and beyond. The other factor to consider is that while the headline rate of inflation has been officially floating around 10% since around October last year, the value of some goods and materials, particularly in the construction sector, which is why this is relevant to those insuring properties in particular, has increased by between 50 and 100%. So way above the headline rate of inflation. And all of that feeds into sums insured. And so what we wanted to do today is to talk to you about the concept of underinsurance, how it might come into play in terms of the impact on policyholders and you as brokers. So before I talk about brokers' duties, Charlotte's going to take you through the implications for the client. What is underinsurance, Charlotte?
Thank you, Ben. So if as many as of half of businesses in the UK are currently underinsured to some degree, with rising inflation, the cost of living crisis, and the long-lasting effects from the COVID-19 pandemic and Brexit, this is only going to get worse. So if the current global situation continues, more and more businesses might find themselves underinsured. If the value of a property, for example, declared in a policy is incorrect, this may result in the property being considered as underinsured, which will have an effect when you're suffering a loss. So if a property is underinsured, it may be subject to what's called a condition of average, or the average clause, or being subject to average. This means that if the sum insured does not represent the value of the property insured at the time of the loss or damage, the insured is deemed to be its own insurer for the uninsured portion of the claim, and therefore bears a percentage of the loss. So the application of the average is more serious than simply not receiving your limit of indemnity. In fact, when an insured self-insures for a percentage of the loss, the amount of any claim will be reduced by that percentage, even where the limit of indemnity is sufficient to cover the loss. So here on the slide, we have an example of an underinsured property. In this example, the property is insured for £5 million. And this could likely be because the property was only worth £5 million at the time of policy inception. So the property is then damaged to the tune of £3 million. And it's subsequently discovered that the value of the property is actually £10 million. This could be because the value of the property was incorrectly stated at policy inception, whether by error or for a cheaper premium. But this could equally be because the property is actually now more expensive thanks to the cost of living increases and inflation. So I'm now going to run a poll. Based on these figures, if insurers apply average, how much will they pay out? Giving you some time here, do some calculations. Hopefully we don't need any calculators. Okay, so the results are in, and happily, many of you have correctly estimated that insurers will pay out £1.5 million. So we can see here on our next slide, the calculation as to how we get to this amount. We see that only 50% of the property value is insured. So when applying average, the insured is its own insurer for 50% of the loss. And this means, though, even though the limit of indemnity is sufficient to cover the damage to the property, in fact, the claim is only 60% of the sum insured. Insurers will only pay out 50% of the claim, as this is the portion for which they have insured the property. The insured is self-insured for 50% of this claim, being £1.5 million. So it's important to note further that the claim will be further reduced by the policy excess, which is only deducted after the claim has been reduced by average. So the above is actually arguably the best case outcome. An insurer may have an argument in these circumstances to say that the underinsurance here is so significant that the presentation of the risk was deliberate or reckless, entitling insurers to avoid the policy, refuse the claim, and keep the premium. So under the Insurance Act, as most of us know, an insured is required to make a fair presentation of the risk. A fair presentation of the risk is one which discloses every single material circumstance which the insured knows or ought to know. So an accurate value of the property insured is a material circumstance which must be disclosed to an insurer. It's been questioned, of course, whether, in fact, the value of the property insured is actually material, where the policy contains an average clause. This is because in any event, the insured would bear a share of the loss and the insurer would not be disadvantaged. The argument to the contrary is that the value of property is important in calculating the applicable premium, as well as the fact that the presence of high value property might have a bearing on the risk of theft. So where the value of the property insured is incorrect because of external factors, such as inflation, supply shortages, this non-disclosure may be innocent. It'll still be a non-disclosure, though, with the Insurance Act remedies available to an insurer, such as the application of alternative terms or the application of a higher premium, resulting in a reduction in the claim payable, or the avoidance of the policy and the return of premiums. So there are some policy types and conditions to consider if underinsurance is a concern, such as a declaration-linked sum insured. This is usually seen in business interruption policies and can accommodate unforeseen growth in a business during a trading year before the next period sum insured is declared. So an automatic uplift of the sum insured, typically as much as 130%, is applied at the time of the claim. This means that as long as the sum insured was accurate at inception, the insured will not be underinsured and it will not have the average applied. So then there is also a variation on the condition of average, which is the special condition of average, which is applied where the value of certain property varies significantly during the policy period. Here, it wouldn't make sense for the insured to pay a full year's premium on a maximum value, which only arises once a year. In recognition of this, insurers may apply a special condition of average, which states that the average will only be applied if the proportion of average or the percentage of average falls below a certain percentage, for example, 75%. So this would mean that as long as the insured is not underinsured to a degree of, say, less than 75%, the average will not be applied. So for all these reasons that I've highlighted, it is so important to be sure that the sum insured is sufficient. It's important to ensure that the sum insured isn't negatively affected by factors which might be out of our control, such as inflation, supply shortages, or increases in property prices and increases in the cost of living. I'm going to hand over to Ben now, who will hopefully be giving us some pointers on how to be sure that property is correctly valued and sufficiently insured.
Thanks, Charlotte. So doing a fair amount of broker work myself, I would say it doesn't take a significant leap of faith to work out where the finger is going to be pointed if or when the client suffers a shortfall of the nature in Charlotte's example a moment ago. So I just want to talk through the broker's duties, and then I'll talk about some practical issues to consider as part of this. Now, because setting the value of the policy holder's risk is so critical, I do think there are some standard but essential duties that apply to the placement of any risk that any brokers are dealing with. And these are fairly generic. There isn't any single one that says you must advise on underinsurance, for example. But firstly, I think the need to identify the type and the scope of cover which the client needs and to provide advice about it is required by case law, and specifically it's required by ICOB's Rule 5.2.2. So the Insurance Conduct of Business Source Book, ascertaining the nature of the client's business and its insurance needs is very clearly an essential component part of being able to provide advice and support about the levels of cover required, about the sums insured that are going into this insurance business, into this insurance arrangement. Secondly, a broker has to take reasonable steps to arrange the insurance cover which the client's instructed the broker to attend and which is suitable for and meets the client's requirements. Again, suitability inevitably equates to ensuring those sums insured are accurate. Thirdly, once cover has been placed, the broker should consider and explain to the client what cover has been arranged. Now, it's important to note here, simply asking the client to read the policy will rarely, if ever, be sufficient to discharge the broker's duty. But I do think there may be some arguments to play around here in terms of sums insured. So if a schedule shows the figures, it might be arguable to say that a reasonable policyholder ought to read those and note any discrepancies. And then finally, renewal. I'm afraid it's true. Do it again. I'll come on to this in a moment because I've got some specific scenarios I wanted to talk about, but the reality is the same exercise is going to be necessary. Now, the nature and scope of these obligations, which are very generic in nature, are going to depend on the circumstances. And so I just want to talk through a few specific categories of what I think are relevant to this topic. So firstly, valuation and the level of cover. And this is a real sticking point, I think, for brokers, because a broker's got an obligation to obtain cover not only against the relevant risks, but also at a sufficient level that protects the client. Now, the question I'm often asked is, does the broker need to go as far as providing the insured value? And I think the answer to that is no. I think a broker must provide advice to the client about what the sums insured should represent. So, for example, and there is a question in the chat box here about this, what is the difference between the market value of a property and its reinstatement value? Now, the question of what figure should go down is going to very much depend on the questions being asked and the level of cover which is being provided. But unless the client understands what those two definitions are, it is not going to be able to provide an accurate answer to the broker. And that is where the risk exposure is. There is an example on the slide, so J.W. Bolam case. In this case, the policyholder was underinsured, and the judge, helpfully for brokers, found that an insurance broker is not a valuer and so cannot be expected to advise on the value of a particular piece of property. All good. But the broker was still found to be negligent because it had failed to provide advice to the policyholder about the need to obtain for the full cover for the full cost of reinstatement of the property to be insured. So it very much shows the advisory aspect to that. Secondly, business interruption. This is a really complicated area, I think, for brokers and clients alike, mainly because the calculation of a sum insured is really quite complex. In line with what I've just said, I don't think there is an obligation on the broker to determine either the indemnity period or the exact sum insured. But I do think the broker has an obligation to take reasonable steps to ensure the client has enough information to be able to make an informed decision and potentially to take advice from its other professionals it may seek assistance from. So, for example, explanation of terms such as gross profit, which has a different connotation and meaning in insurance terms to what it means to the average businessman and or accountant. So that's really quite an important one. If the client doesn't understand what the term means, they are not going to be able to provide the figure. So the figure may be incorrect, but the rationale behind it is important. Now, obviously, there's two constituent parts to BI. You've got your sum insured, but also the period of cover. Do you put your finger in the air and say 12 months is fine? Well, I don't think that's going to be acceptable. The duration of cover is going to need to be long enough to meet the client's, the policyholder's requirements. So they need to understand terms such as maximum indemnity period so that they can work out how long or how much cover they need to get back on their feet afterwards. I've mentioned sophisticated clients on the slide because I think this is a real area of interest, because I think the nature and scope of a broker's obligations in terms of assessing their insurance needs depend on the circumstances of the particular case. And those circumstances include the client's sophistication. So it might, for example, relate to how many times the broker has met the client in the past, how well that client understands the insurance aspects. The two cases I've included on the slide, Synergy Health and Eurokey, both really helpful for brokers in this respect on the face of it. So the requirement the courts have imposed is that if a client appears to be well informed about the business and they provide the broker with information, a broker is not expected to verify or correct or question that information unless there is good reason to believe it's inaccurate. Now, this is all fine in principle, but you can bet by the time of a claim, things will be very different. So where is that evidence of sophistication? Because I've seen plenty of claims, I've defended plenty of claims where a broker tells me when we received the letter of claim, well, the director of the client was really well informed. Unsurprisingly, and this might just be me being a professional cynic as a defendant's lawyer, by the time of the claim, that supposedly well-informed director claims to know little or nothing about the reality of insurance. They know how to run their business, but they don't know what gross profit means, for example. Now, knowledge and sophistication is really quite hard to evidence, and I can't ever recall seeing a note on a broker's file attempting to explain it. And as I say, the client's position post-claim may be very convenient. It may well benefit from hindsight, but it's actually very difficult to second guess, and it's very difficult to disprove. So it is an area to be very wary of. Just quickly on renewal, I think this is something we see a lot of claims on, and probably more so than the first year following inception. A client may not need or particularly want their broker to repeat advice that they received 12 months earlier. But it doesn't follow that it's acceptable to simply undertake a box ticking exercise. From an underinsurance perspective, there may not be a need to repeat the advice about certain issues, so repeating that information about gross profit. But businesses change, figures change. The client may well have grown, they may well have retracted, they may have acquired new employees, new machinery, new properties, or even other businesses. So what was true 12 months ago isn't necessarily correct now. As Charlotte talked about, in the context of double-digit inflation, sums insured are not necessarily going to be accurate. And I think that's an area to really focus upon. It may be that new estimates are required from the client's advisors about the valuation of property and goods. And finally, and perhaps most importantly, from a claims defensibility perspective, the argument that you don't have to give advice a second year running rather assumes that you recorded the advice you gave last year. So the onus is on you as a broker to prove the advice that you gave. Now, before we sign off, just a few practicalities, really. I think those stats that I provided on the very first slide show that it is more likely than not that your client is actually underinsured. And I think that current economic position does mean, unfortunately, that in the context of difficult conversations around sums insured, because they inevitably or almost inevitably link into increased premiums, but I think it's the broker's obligation to deal with this. And those stats, I hope, give a bit of assistance to show it's not the broker's fault. This is what the market is telling us. This is the market telling us that more often than not, clients are not going to have sums insured that are adequate. As I said earlier, there's no expectation that brokers should value the client's property or to provide the sums insured, but you do need to give advice. You need to ensure it's written down. I don't think you discharge your duty by relying on an insurer's literature, except in very specific circumstances. Rather than relying on rough estimates, do urge your clients to obtain up-to-date valuations by experts who know what they're doing. Do consider changes to the way the clients use their property. So they may well have had changes of use of properties, in particular post-COVID. From a BI perspective, how long do they think they will need to get back on their feet if there's a catastrophic event? There's some information from that the government released in a report not so long ago that something like 80% of businesses of SME businesses who've had a catastrophic event go under within 18 months of that event. And so it just shows how important the insurance money is. Just on determining the values, I would be very cautious to simply rely on index linking. It's particularly the case with a new client who's come over from another broker. If the previous broker failed to set the sums insured correctly, index linking is not going to fix the problem. And if an insured event then occurs, that's occurring on your watch. The previous broker's error is irrelevant from the purposes of a future claim. And finally, in terms of the context of advice, I think you need to go further than just saying sums insured need to be accurate. I think you do need to explain the implications of what happens if this all goes wrong. So, for example, in Charlotte's example, the client may well might not be insured for the full amount of their loss. So, a bit of a whistle-stop tour. We've had a couple of questions come through. First one was on Charlotte's point near the end. For a declaration linked sum insured, the sum insured goes up how does that have an impact on the premium? Well, it does. The insurer at that point can charge more premium, but obviously the benefit is that the sum insured ought to then be more accurate, at least more accurate, and so the claim ought to be paid. And there's one interesting one, which is what causes underinsurance. You as brokers on the call may know better than I do. I suspect it's a mix of a lack of understanding, perhaps around advice and also on price. And when I say advice or a lack of advice, I don't necessarily just mean brokers. Businesses will have a host of advisors. There may be accountants, there may be other property related parties, but those parties' role will primarily be around the wider business rather than necessarily its insurance needs. And that's why the policyholder needs direction from the broker. In terms of price, I suspect it is a factor. I doubt many policyholders are going out their way to intentionally underplay their figures or mislead insurers. There may be some out there, but I suspect it's more about a failure to really understand the nature of how insurance works. There have been no other questions. So really just to thank you for coming along and listening to us today. We have a further session of the box on the 25th of April, and James Thompson will be presenting on a topic on that day. Thank you very much, and have a good day.